Let's look at exercises 1113 through 1115. So we're going to look at all three of these, calculating the contribution margin and transfer pricing in these different scenarios. So the question stem for 1113, let's start there. Alpha Division produces and sells a key part. Currently, Alpha sells this part for $250 per unit to their customers. Alpha has the capacity to produce and sell 5,000 units. As of now, Alpha has orders for 2,000 units to external customers. To produce and sell this part, Alpha incurs the following costs: variable production cost per unit of $100, variable selling and admin cost per unit of $40, fixed production costs in total of $130,000, fixed selling and admin costs in total of $55,000. Omega Division within the same company is interested in purchasing this part from Alpha. Normally, Omega purchases this part externally for $150 per unit. Omega wants to purchase 1,500 units. What is the contribution margin Alpha Division is generating on external sales? So we start there. We're looking at it from Alpha's perspective here to see what contribution margin are they generating, because we need to understand that in order to know what price to charge Omega if we are going to do this intercompany transaction. And remember, the whole point with transfer pricing is we want to ensure, from the compliance standpoint, is to ensure we're not shifting profits overseas or from one country to another by artificially lowering the price that we're charging a division within the same company here. And that's kind of the whole premise of transfer pricing. But let's look at exercise 1113 here. Reproduce some of the information here. So selling price, again, $250 per unit. Variable production cost per unit of $100 a piece. Variable selling in a minute 40. Fixed cost per unit of 26,000. And again, how did I get that? I took the total fixed costs incurred divided by the number of units produced, 130,000 divided by 5,000, got me fixed production cost per unit of 26, and then fixed selling and admin in total of 55,000. So the external contribution margin that Alpha Division was charging, remember, how do we calculate contribution margin? It's selling price minus our variable production costs per unit minus our variable selling and administrative costs. So we're dealing with these three amounts right here. If you look at the formula, it's the selling price of $250 minus the variable production cost per unit of 100 minus the variable selling and admin of 40 gets us an external contribution margin of $110. And again, that's important because Alpha, no matter who they sell to, they probably want to maintain that contribution margin of $110. Now, looking at exercise 1114, the costing information is still the same. They sell it for $250, produce capacity is 5,000 units. They're producing 2,000 units. Omega Division within the same company is interested in purchasing this part from Alpha. Normally, Omega purchases this part externally for $150 per unit. Omega wants to purchase 1,500 units. If Omega purchases from Alpha, variable selling and administrative costs per unit are cut by 50%. So what is the optimal transfer price that Alpha should charge Omega? So there's a few issues that we have to be concerned with here or have to take into account. The issue with this question, again, is the contribution margin that Alpha would be giving up if they were to forego or to sell directly to Omega. They want to maintain that contribution margin of $110. Now, in this instance, remember, capacity is 5,000 units. Currently, Alpha is dealing with production of 2,000 units. Omega wants to buy 1,500 units. So there's enough capacity for Alpha to fit in the Omega order and not, sacrifice anything with external clients. So since Alpha has excess capacity to sell to Omega, as I said, there is no sacrifice of contribution margin. Therefore, there is no opportunity cost to Alpha. So we don't have to be as concerned with that. And then it also says selling to Omega cuts the variable selling and admin in half from $40 to $20. In this case, our formula for figuring out what is the price that alpha is going to charge, it's simply the variable cost per unit. So to cover the variable costs, which is the production costs of 100, and the new variable selling in admin, which was 40, now it's 20. So we have to cover those plus any opportunity cost. But again, in this instance, alpha is not giving up anything. They are not foregoing something by choosing to sell to omega. In other words, they're not giving up any contribution margin. So in this example, this here, opportunity costs per unit, is actually 0. So in this scenario where there's excess capacity and alpha is not giving up anything to sell to omega, the only costs that they have to cover are the variable costs per unit. And you see the formula there. So the transfer price that they would charge is $120. Now, exercise 1115 works a little different. It's the same assumption as 1114. However, now we're assuming alpha is operating at full capacity. If that's the case, what is the transfer price alpha should charge omega in this case? Now that alpha is operating at full capacity, there would be an opportunity cost of $110 to alpha. So they have to account for that in the price that they are charging Omega Corp or Omega Division. And again, since they're selling internally to Omega, the variable selling and min are going to be cut in half. So the transfer price in this instance, it's still the variable cost per unit, which is $120, which is again the variable production cost of 100, and then 50% of the variable selling and min rate that they're charging externally, so $20 there. But now there is an opportunity cost. The opportunity cost here is cell B8, which is the contribution margin per unit that alpha generates from external sales. Because of that, they have to include that in the transfer price here to make themselves whole. Therefore, the price that they charge, it's not the 120 that we calculated in 1114, it's $230. It's the 120 in variable cost per unit plus that opportunity cost, which is the contribution margin alpha would generate if they were to sell these units externally as opposed to internally to Omega. So they have to charge them the full freight, full contribution margin. That's why the transfer price here would be $230.